is tech moving? Tech's moving because the innate fear of inflation is subsiding. There's a lot of evidence out there that's showing that inflation, like the Fed had been speaking about for months on end, may actually be indeed transitory. Imagine that. You know, it's so funny to me that you have all of these analysts and hedge funds that get paid all of this money, and all you ever hear them say is don't fight the Fed. And then they start fighting the Fed, right? I mean, Jerome Powell comes out and says, hey, we see inflation's happening. It's going to be a thing, you know, but it's going to be temporary. And when you look at some of the things that are, you know, have succumbed to inflation, it's stuff like used cars. You know, the last month, we saw CPI numbers. Used cars took up a third of those numbers, and so that's something. Used cars are not going to stay high priced or overpriced for very long. It's just not going to be a thing. I will say that there could be some stuff out there that may stick. You know, higher wages, that sort of thing may actually end up sticking. Nobody's going to like start paying you less money. But I think overall it is going to be transitory. And you have a lot of these analysts that have been fighting the Fed this whole entire time. And now all of a sudden, hey, they're like, oh, hey, you know what, Jay? You know what, Jay Powell? You might be right. You might be right. Yeah, might be right. And so what happens? The 10-year yield goes down. When the 10-year yield goes down, tech starts to go up. And we talked about this a couple of weeks ago. We said particularly FANG stocks were actually going to do really well. And I myself actually am in Facebook, and it's been doing awesome. It hit all-time highs today. That, I think, to me, is going to continue to be a thing as long as people buy into this notion that inflation is going to be temporary rather than permanent, and we're not going to see a repeat of the 1970s. And I've been saying till I'm blue in the face that I don't see that happening, and that I was agreeing with the Fed this entire time. I was not trying to fight them, and I was trying to understand where they were coming from. And so looking at something like Facebook, I mean, this thing just keeps going up. You buy the FN dip and move on. You know, it's just one of those things where it's going to continue to go up. And I see that, I mean, today the 10-year yield is up, but when you look at how far it is from its highs back in March, it's not even close, right? I mean, we saw the 10-year yield this week drop down to 135 overnight, I believe, on Monday morning. Overnight, it was, 135 Monday morning. And it's up slightly, but nothing like we saw back in February, March. Now, I will say, right, that the 10-year yield, the 10-year treasury yield is still very low. Right now, we're looking at the 10-year treasury yield, and it's sitting at 1.487. It's up 1% today. If we see incremental movements of the 10-year yield go up as the year goes on, I think that the stock market remains exactly the same. It's going to continue to grind higher. The economy is going to continue to be on fire, and everything's going to move together. I still believe that things like energy, oil, commodities, reopening plays, they're going to outperform tech. But tech is finally starting to bounce back here. And so that's why we said, hey, this is why we actually said, don't leave tech in general, but also pay attention to these value stocks as well, because they're going to probably outperform this year. And so far they are. I mean, energy's up, 48% on the year. It's absolutely crushing the S&P, which is only up around 13%. I say only because it's still like fantastic for the S&P. But when you compare it to energy, that is phenomenal, right? I mean, crude oil right now is at $73.29. And so what do you look at right now with everything moving? I think it's just really, really important, and we've been hammering this home for a long time, to have a well-balanced portfolio. Now, I think that I need to clarify a little bit, because I just got done telling you that I was in Wish, right? I traded Wish with 5% of the value of my account. So I want to bring some perspective. I own a lot of stuff that I carry for a longer term swing trade, or maybe even a longer term investment. And then I have stuff that I want to just play around with, like a Wish or a Clover, or even AMC. I would trade with 5% of my account if I saw the setup. But I think it's important to understand that I'm not whole accounting these speculative plays, these super speculative plays, but I'm also hedging and balancing out my portfolio. So I took on things like OIH, which is the oil services ETF that houses things like Schlumberger and Halliburton. And they've been lagging the rest of the energy sector pretty significantly. You look at the chart right now, my average on OIH is around 210. I've initially made an entry onto this and have been scaling in since 194, I want to say, and it's been doing incredibly well. I was a little bit, I won't say unnerved at all, but I was a little bit, I guess, frustrated when it came back down and broke below that 230 support. But man, it blasted right back up through there. It did not hold today, but I'm not worried about it whatsoever. I think it was good to see this make this kind of move, at least try to break back up over that. Had a really great morning this morning, but I love OIH. So this is one that I think that it would be good to hold if you guys agree with me that we could see energy continue to surge. Another one that I'm in is MRO. If you guys don't like something that's this high price, I understand, I get it, even though I think that it doesn't make any sense. If you think that something's going to double, it doesn't matter what price it is, and I think OIH has the potential to do that. But nevertheless, you look at something like Marathon Oil. It's priced at $13.58, and I've been talking about this since I've been in it at 11. Did I get in at the bottom? No, but I'm making bank still, you know? And so it's still going up. I still think it has potential to go even higher. 14.16 was the high back here a few weeks ago, and it's been consolidating over the last, Thursday, Friday last week, along with everything else. It took a dive and then held up pretty well above 1250 and is continuing to move. So my point is of just having a good, well-balanced portfolio. I still think that tech is going to be something that you should own, but I also think that it doesn't mean that you abandon the stuff that got you through March, April, and May either, because they're going to continue to roll. The 10-year yield is going to continue to go up. I just don't think it's going to go up in the same, with the same velocity in which we saw it go up in the wintertime. I think that it's very possible to see the 10-year yield get up to 2% by the end of the year. If it starts to move now, I think it could get up to 2% by the end of the year. And if it moves like that gradually, then the stock market's not going to care as much. What happened in February, March of this year, the 10-year yield just went crazy high in a very short period of time. And I mean, it essentially tripled within about 6 weeks. And that's just not normal for a 10-year yield to do that. And tech stocks suffer for that. They don't have as much they can't borrow as easily and all that good stuff. So it affects them for long term. And that's why they sell off. If the 10-year yield gradually moves up like this, I think it's going to be much better for people who own a lot of tech. But I think, like I said, it's still going to be important for you to own energy and the reopening plays, because they're going to continue to be monstrous, especially some of the hybrid ones, right? I own Airbnb. It is considered a tech stock, but it's also a reopening play. Those are good ones. Square is going to be a good one. It's a good hybrid. You get the best of both worlds. And I think those are going to be good.